Welcome to this special. CNBC-TV18 polled 30 fund managers on where the market is headed in the second half of the year and asked them what are the risks and which sectors could perhaps be the leaders. Let's take a look at some interesting findings and get a peek into how the second half could play out for the year. Well, to begin with, our first basic question was, is this market heading higher in the second half of 2023? The overwhelming response was yes. Almost 77% of the respondents felt that we're indeed going higher from current levels. So then the next question, where will the Nifty end the year at? Now here the majority, that's almost 42%, feel that the Nifty could be between the 20 to 21,000 mark. That's the biggest group of respondents. But the next group, that's about 21% of the respondents, felt that the Nifty could be between 19,000 to 20,000. Interestingly, very few fund managers felt, that's just about 10% out there, felt that we will see a blowout rally that could see the Nifty head beyond even 21,000. The next question. So which sectors could lead the up move? Here there was almost consensus that it's going to be banks which will lead from the front. That's a sector up there with 63%. People felt that autos would also contribute despite a 22% rally in the first half of this year. Fund managers also expect pharma to be contributors as well as FMCG. Interestingly, despite expectations of a very weak first quarter, fund managers still feel that IT can be a meaningful contributor in the second half. So these are the key sectors which could drive the rally. Let's move to the next question. Now, the consensus says that banks will take things higher. So where will the bank Nifty be by the end of the year? Nearly 40% of the respondents see the Nifty bank between 45,000 to 47,500, but 21% of the respondents actually see it heading even higher. That's above the 47,500 mark, which is just about a 5% up move from current levels. Almost no fund manager is expecting any meaningful correction in the Nifty bank. That's a more than 10% correction. That number is just 3.6%. The next question. So what will the performance be like when you're talking about market capitalization, different segments? Here, almost 49% of the fund managers feel that large caps will lead the market rally. Almost 41% feel that it will be small caps. Very few, only 10% feel that it will be a mid-cap driven rally alone. Let's talk about fund flows now. And again, between domestic institutions and foreign portfolio investors, the consensus feels that it's both of these segments that is going to be driving the market higher. In fact, we've seen a huge gush of liquidity from the FPIs, and that is expected to continue in the second half. The other question that we asked, will we see heightened IPO activity in H2? And the response here is yes. 69% of our fund managers said that yes, we will see more interesting listing action. Let's move to the next question. And these are some macro questions that we threw in as well. So starting with GDP growth projections, what will FY24 look like? Here, the consensus is that GDP growth is going to be between 6 to 6.25%. That's the bulk of it. Majority feeling that it's going to be 6.25%, some also in the 6% camp. And very few are in the outlier category, saying that, it will fall below 5.75% or jump above 6.5%. Let's move to the next question. That's rate hikes. Now, here the majority view is that we'll not see any change in interest rates. That's almost 48% of the respondents. 25 basis points cut. That camp is about 37%. Whereas very few, hardly any, respondents are really expecting a hike in India this year. Coming to the 10th question, are we going to see more block deal action, the frenetic activity that we saw in June? The answer is yes. Expect more block deals from maybe promoters or early investors. That's almost 90% of the respondents. And finally, what is the biggest risk to the market? Interestingly, it's not local factors, but more global factors. Either a US recession or geopolitics. Those are dominant themes when it comes to big market risks. Not so much, the election outcome, which is also important, but not at the top of the mind. And finally, even a tighter monetary policy or even, the lack of a very good monsoon so far, that's not really a big concern. Overall, the view is positive, with fund managers expecting a strong second half. Okay, so that is our poll. Earlier in the day, we decided to get some views on this as well. We caught up with Sunil Singhania, founder of Abacus Asset Management, to understand his view on the market given the big run-up. He's saying that he will still deploy 20 to 30% of capital in the markets now.
See, as far as liquidity is concerned, obviously liquidity does aid markets, but liquidity can aid the market only for the near term. I think we have to also realize that it is also a function of the differentiating fundamentals which India as a country has been witnessing over the last couple of years. So, we always say that in 22, when the world was debating whether there will be a recession or 0% growth, in India, the debate was whether we'll grow at 6% or 7%. And we ended up growing at 7%. All the macroeconomic factors have turned out to be positive. The concern about monsoon is also allayed significantly, with the deficit being cut almost to negligible levels. And corporate profit generally have been pretty good. And the indications which we are getting from early, sort of numbers as far as June quarter is concerned, whether it was banks, advances, even now the jewelry companies reporting, and even some of the consumer companies reporting, clearly indicate that as an economy also we are in a very good position. And I think lastly, we should not forget the fact that, the crude is at $75. And that would mean that the balance of payment for India would have never been as good as it is today. So I think, yes, there is liquidity. And yes, there has been an uptick in the market, which has been very sharp over the last 3 months. But it is backed by fundamentals. And lastly, year to date, we are up like 5-6%. It's not that we are up majorly, So if you see 23, we are up like 6% on the Nifty. It's only from the bottom of March, we see that Nifty has moved up maybe 15%. But year to date, we are up only 6-7%.
This market is great if you're already in the market, right? You've already been investing systematically for the last couple of quarters, years. But for a fresh entry point, is this an attractive entry point, or do you think it's too overheated to get in? Because at the end of the day, even the price at which you enter matters.
So, you answered your own question. The moral of the story is that be invested regularly, irrespective of the levels, and you won't be disappointed. If you just look at timing the markets, I think you missed the bus in March because, the investors were too concerned about what was happening on Silicon Valley Bank and Credit Suisse and so on and others. And now, you're worried that markets have moved up. So, if you just keep on worrying, you will always be on the sideline worrying when to enter. Yes, we are also of the view that there is one pocket of the market, particularly on the smaller companies, which is overheated. There is definitely a fear of missing out, which is also creeping in. And one has to be careful. But, we are in the camp which would say that the market might react 3-5%, but we are not going to see a major correction. So I think if you're a fresh investor, maybe, you put in 25, 30, 40% of what you want to invest now and pray that you will get a correction.
So Neil, what about from the broader markets? We're still far away from that euphoric stage.
Nigel, what is euphoria? Euphoria is when P's become 30 and 40 at the Nifty level. We are at like 19 times, on the Nifty side. And at least our view is that for a change, the next 2 year earnings might see an uptick, which will be more than what we anticipate. So we are not in a euphoric stage as far as the market is concerned. As I said, some pockets, particularly smaller companies, are seeing that scenario. But overall, at a overall market level, I think we are maybe 10% overvalued, but not definitely in a euphoric stage.
So let's come down to the areas. If someone's going to put fresh money to work now at these levels, at these all-time highs, then where do you look?
India is a country which is very diversified. We have presence across sectors. We have entrepreneurs who are at work, again, across sectors. And, unlike, market performances definitely don't mirror the views. So, you mentioned about IT, that, everyone is definitely a little bit sanguine about IT, which is rational also given the slowdown which we are seeing. But actually, if you see year to date, some of the IT stocks have been great outperformers. So, a lot of times the view on the sector is already discounted as far as the markets are concerned, both on the positive and the negative side. We are definitely in the camp which believes that banking should start to perform. And it's a good 2-3 year play. Credit growth has been very strong, and the initial numbers announced by most banks clearly point to almost 18 to 20% growth in advances. NPAs are non-existent. Yes, there has been a little bit of increase in interest rates, but I think that is more or less factored in. And from here on, we might see some relief as far as the interest rate is concerned. At least we are in that camp. So I think financials obviously look pretty decent. We are also of the belief that discretionary spend should pick up. April to June was not great. But, come the festive season in the second half of the financial year 24, we are very optimistic that discretionary spend will pick up in a major way. And I think that is where we are invested. Capital goods, again, is a great theme, great sector, though the stocks are not very cheap, so one has to be very careful. And in a very small theme, I think steel is something which we like selectively, though China has not been growing the way people expected post the reopening of the economy. But I think steel is one place where we believe that Indian companies have great moat. Their integrated balance sheets are very clean. So in a small sector, I think steel will be something which we would look at. Pharma, looking at it, not jumping into it, but again, valuations there are now much more reasonable than where they used to be.
Why are you not jumping into pharma as yet? What's keeping you on the sidelines?
So pharma, as a sector, obviously has become cheap, but stock specific, one has to be very careful because, there is a enhanced sort of scrutiny as far as regulatory issues are concerned. So we are equal weight. We have not gone overweight, but there are some companies which we believe will get an opportunity in the next 3-4 months.
Sunil, what about the railway theme? That has played out very, very well. And I think you all latched onto it very, very well as well. A couple of stocks are on public domain as well. Titagarh Wagons, I think. So how much of the good news is in the price for this entire railway theme? Because it's got a long runway. The kind of moves that we're seeing from the government of India as well, the kind of importance that it's being given. So your view on that space, capital goods we got. What about the railway theme?
No, I think railway is again something, there is a lot of spending happening. In fact, I traveled by the Vande Bharat for the first time 10 days back and I was pleasantly surprised. And we had some exposure, but Nigel, very frankly, we could have had more than what we had. But we also did not anticipate the kind of ordering which we saw as far as this sector is concerned and will continue to be in this sector. So we are having some exposure. We are also looking at some indirect ways of playing this theme. I think there is a huge tailwind, and I would say that remain invested. Though some of the names which you mentioned, I think now a lot of what is going to happen over the next 2-3 years is sort of already discounted.
So at the index level, you're saying we're probably overvalued by 10%. But where are the pockets where the overvaluation is far more, where valuations have run ahead of fundamentals and you're uncomfortable?
So, as a fund house, we are very value conscious. So there are a lot of sectors where we are uncomfortable, but being uncomfortable does not mean that the price will fall, right? So there are investors who are willing to take that call of 4-5 years of rapid growth. And there is justification maybe, for companies which have moved up quite sharply. So we must stay away from fashion or themes. We are, I would say, slaves of numbers. So wherever the valuations are 50, 60, 70 PE with growth of only 10-15%, we tend to be a little cautious. But where there is growth of 25-30% expected, we don't mind paying even 30-40 PE multiples. So, it's very simple, just look at the valuations and the growth rates. I think if the valuations are like 4-5x of the expected growth rates on an annual basis, I think those are the sectors, theme stocks, which we will stay away with.